Ladies and gentlemen, good afternoon. Welcome to Emerging Markets ESG webinars that will introduce you to the practical guide to ESG reporting through investors' eyes. Today we are hosted by the Principal of Emerging Markets ESG, Geoffrey Mazullo. Before I give the floor to Geoffrey, a short reminder about the agenda of the webinar. First, we will have a presentation about ESG, after which Geoffrey will answer all your questions. If you would like to use this unique opportunity to ask a question directly to Geoffrey, please use the question box on the right-hand side of your screen. All questions will be addressed after the presentation. Geoffrey, I invite you to start the presentation.
Thank you very much, Eva. Labdien, Tere. Good afternoon from sunny Arlington, Virginia. And it's my pleasure to be with you for this next hour. The presentation part will run about 45 minutes. And then we have questions and answer session. And again, we hope it will be an interactive session and you'll use the chat function to ask questions, make comments, share information with everyone. So why this webinar? Well, there's a new directive, Directive 2014-95 EU, regarding the disclosure of non-financial and diversity information. It amends the Accounting Directive of 2013, and it requires certain large companies to disclose in their annual report information on policies, risks, and outcomes regarding environmental matters, social and employee aspects, human rights, anti-corruption, bribery, and diversity in the board of directors. Affected companies should disclose this information in their annual report for 2017, published in 2018. Here I should mention that in Estonia, the deadline is actually a year earlier, so actually in Estonia, companies should already be reporting this information in their annual report for last year, published this year. So because of these deadlines, this webinar will provide a brief practical overview of environmental, social, and governance, so-called ESG reporting, from the perspectives of regulatory requirements and also investor interest in ESG disclosures. A little bit about me, since we'll be working together for the next hour. First of all, many of you may know me as chair of the evaluation committee of the Baltic Market Awards. I have been working in the corporate governance industry for almost 25 years now. In the early 1990s, I was a corporate governance analyst, first with Institutional Shareholder Services and then with Investor Responsibility Research Center, covering the German-speaking markets and also Scandinavia. I studied economics and political science at Georgetown University School of Foreign Service and then received my master's degree from the London School of Economics and Political Science. After working with IRC and ISS, I worked on several corporate governance projects related to privatization, post-privatization, and corporate governance regulation throughout Central and Eastern Europe and Russia. And then for almost 10 years, I was the director of the Partners for Financial Stability program. This was a regional program active in the region, including the Baltics. And while I was there, I launched two surveys. One was called Investor Relations Online, and one was called Reporting on Corporate Social Responsibility. So I've been looking at these issues of financial and extra-financial reporting in the region for quite a long time. And now I'm independent, running a small boutique advisory firm looking at ESG reporting about emerging markets and throughout emerging markets. So here's our agenda. We're going to try to assess and understand how we move from corporate governance to ESG, a quick overview of ESG disclosure requirements in Europe, sort of the why of the reporting, then the how of the reporting, a quick checklist of how to get started. For those of you who might already be in the process, it would be a good checklist, and for those beginners, it would be a great way to start creating a system and a process. I want to briefly talk about the business case for ESG reporting, moving away from viewing it simply from a compliance perspective to more an added value and an innovation perspective, and then look at why ESG is important to investors, share some resources with you, and then, as Eva mentioned, we have a Q&A session. If you're already thinking of questions, please jot them down, and then we'll get to them at the end using the chat function. So as I mentioned, I began work as a corporate governance analyst in the early 1990s. A sort of rethinking or recalibration of corporate governance regulation, it occurred first in the UK and in the US, largely in response to corporate scandals. This thinking was spearheaded by shareholders and by regulators. The focus was on corporate governance or governance per se, and the goal was to use the corporate governance to promote long-term financial performance. Now, from the very beginning, skeptics said, well, there's no proof that this makes any difference. There's no proof that good governance reduces risk or that it improves financial performance. But the common sense prevailed. Other jurisdictions throughout the EU began work on this, began drafting corporate governance codes, and in time research began to demonstrate the correlation between governance and risk and governance and financial performance. Now, in contrast, the demand for greater ESG data has emerged primarily in the EU, not in the US or the UK, and it's coming not just from regulators or from shareholders, but it's coming from a range of stakeholders: academics, activists, non-governmental organizations, consumers, international organizations, and the media, as well as regulators and shareholders. And here, the goal is really to achieve a paradigm shift, namely consciousness that each corporation faces extra financial risks. And these extra financial risks impact financial performance, and that each corporation does impact the community and the environment as well as investors, shareholders. This is the reason why in the EU we have this new directive that requires extra financial and diversity information. So very briefly, for corporate governance, we had federal legislation overseeing public pension funds. In the UK, the combined code that recommended splitting the chairmanship of the board of directors from the CEO. The issues, again, corporate governance per se, very much the relationship among the parties within the corporation. So we're looking at dilution of ownership, executive compensation, independence of board members, shareholders' rights, financial rights, information rights, voting rights. All of these issues which you're familiar with through your corporate governance codes in each of the 3 jurisdictions in the Baltics. The focus, the role of owners or institutional investors in governance, policy, largely through corporate governance codes, largely implemented by stock exchanges. This led, though, to the creation of corporate governance ratings by service providers and corporate governance indices by service providers. Later, the Sarbanes-Oxley Act in the US, again in response to huge corporate scandals, and the second combined code in the UK started to focus on internal controls. But here we're looking at the governance of the corporation writ small. In contrast, during the past decade or so, the financial industry has embraced ESG, environmental, social, and governance, as a standard acronym to describe those extra financial indicators that are not purely financial ratios. So the EU is a driver. The institutions, as I mentioned previously, academics, NGOs, consumers, international organizations, and the media. The issues are not just G, they're not just governance. Environmental issues include climate change, emissions, water. Social issues, impact on the community. Governance issues, again broadly, more broadly than previously, to include corruption and diversity of board members. Focus, again, not just on governance of the corporation in and of itself, but impacts and risks throughout the corporate supply chain, and not only on shareholders, but also on stakeholders. So this is where we are. This is why this directive has come into pass, and this is why it's important for companies to understand how we've moved from corporate governance to ESG. And the way I see it, ESG is in the middle. On the left, you see corporate social responsibility. So in a CSR report, the company would disclose its impact on stakeholders, not just shareholders and owners, but stakeholders. On the right, you see that investors analyze the company's CSR practices, and they use this environmental, social, and governance data to make informed investment decisions and then engage with the companies. And we're going to talk about that when we talk about the investor's perspective on ESG. So ESG, it's the software, it's the language, it's the data points that classify all those different environmental, social, and governance risks and impacts that the corporation has. And 25 years ago, you might not have seen this, but in 2008, we see an article in the Financial Times that shows SRI, socially responsible investment, as a mainstream asset class. So because of the financial crisis, institutions are forced to rethink investing strategies. So they're looking at hedge funds, currencies, property or real estate, commodities. They're moving out of active equity. But even if they're moving out of active equity, they might be moving into socially responsible investment because it's a separate asset class that has factored in ESG risks into the investment process, and therefore it might be attractive even if active equity on a broader scale is not. How did we get to the implementation of this new directive in the European Union? Let's take a quick historical look back towards the development of ESG and or SRI regulations across the European Union. The beginning was in Belgium in 2004, the first country in the European Union that passed legislation explicitly prohibiting the financing of anti-personnel mines. This was due to the fact that the United Nations had passed a law, a convention, a treaty, the Convention on Cluster Bombs, and as a result of that, Belgium made it explicitly illegal to finance, not to produce, but to finance those mines. Later, there was a ban on investments in companies that manufacture cluster bombs, 2007, and then similar legislation in Ireland in 2008 and Luxembourg 2009. What does this have to do with E, S, and G? Well, it has to do with the S. In other words, that legislators in those individual countries said, we consider this to be socially unacceptable, and therefore we prohibit financial institutions from financing it, and therefore it puts an onus on the companies to know more about their portfolio, investors, excuse me, to know more about their portfolio, where they are investing. Denmark was the first EU member state that passed legislation requiring CSR reporting. In 2008, the law requires CSR reporting by large listed companies and financial institutions. And what's interesting, also similar to the situation with the EU directive, a company must disclose its policy, how the policy is implemented, and its achievements, or state that it has no policy. First reports were issued in 2010 for the fiscal year 2009 to 2010. So there are some good examples now for quite a few years in Denmark about this type of reporting. In the United Kingdom, I'm quoting from the K review of corporate governance. Institutional investors acting in the best interests of their clients should consider the environmental and social impact of companies' activities and associated risks among a range of factors which might impact on the performance of the company or a wider interest of savers in the long term. This was groundbreaking in terms of moving the benchmark for fiduciary duty and saying, yes, environmental and social impacts are important, and these risks might affect corporate performance, and they might therefore be of interest to savers over the long term. So now we come to the directive. I will read a quote from it so we see exactly who is an affected company. So this is EU Directive on Disclosure of Non-Financial and Diversity Information by certain large companies. According to the directive, first reports to produce in 2018 for the 2017-2018 financial year. Again, we spoke about the fact that the deadline is 1 year earlier in Estonia. Large public interest entities, listed companies, banks, insurance undertakings, and other companies so designated by individual member states with more than 500 employees should disclose in their management report relevant and useful information on their policies, main risks, and outcomes relating to at least environmental matters, social and employee aspects, respect for human rights, anti-corruption and bribery issues, and diversity in their board of directors. And since then, there's been quite a lot of movement in France. So in 2015, in the energy transition law, the law defines the role of institutional investors in financing the transition to a low carbon economy. This includes, for example, for new real estate projects, that there has to be some form of clean energy built into commercial buildings. January 2016, official label for socially responsible investment funds. The French Ministry of Finance set standards for asset managers and financial products. If an asset manager or financial institution is launching a financial product that it claims is a socially responsible investment or ethical or green product, they must choose a labeling institution approved by the French Accreditation Committee to actually verify that product. So there's no monopoly here. There's not only one labeling institution, but they can go to a number of institutions, ask that institution to conduct due diligence, and then certify that this product is in fact an SRI fund. And finally, very recently, from last month, there's a new law in France called the Corporate Duty of Vigilance Law. Large French companies with more than 5,000 employees and multinationals with more than 10,000 employees operating in part or in full in France must establish and effectively implement a vigilance plan which shall include reasonable vigilance measures seeking to identify and prevent human rights violations, breaches of fundamental freedoms, violations of health and safety, as well as environmental damages. So here we're looking under the perspective of the supply chain, and France has gone even a little bit more further than the EU directive. So that's the background. As we discussed, first, from corporate governance to ESG, from looking just at the relationships within the corporation and the governance issues, to more broadly looking also at environmental and social risks, as well as environmental and social impacts and how they affect financial performance, which is of interest to shareholders, but also more broadly to stakeholders. Then we took a quick scan, looking back in history at how consciousness about these issues has grown in individual member states and throughout the European Union, looking at specific legal requirements related to ESG issues. Now, let's change our focus and think, how could a corporate get started with the process of ESG reporting? And I've come up with a 7 step-by-step process. As I said, we might have a very diverse audience with some companies who are already in the middle of it or are already quite far along, complete beginners. We'll go through the step by step, and then we actually have a poll question coming up about this, and then also in the Q&A session we can talk a little bit more. So first of all, analyze the requirements of the directive if you haven't done so already. Then study the various standards that corporates use for ESG reporting. There are quite a few. I don't have time to go into them in detail, but it's important just to list them. And this is a good segue into point 3, which is then conduct due diligence by utilizing the many free online resources that are available. I stress that these are online and these are free, so there's no cost, very easy access to the information to conduct that due diligence. Then establish a baseline for your ESG disclosures. If you're a beginner, if you've never issued a CSR report, if you're not a member of UN Global Compact, if you've not done this before, the first step really needs to be to say, okay, we're starting from a baseline for January 1st, 2017, and establish what that baseline is. It's crucial to engage with your stakeholders to identify what are the significant or material issues. These could vary by company, these could vary by industry, but it's very crucial since ESG is very much about engagement with stakeholders, and it's very much driven not only by compliance, but also by a rethink in order to address these issues and create more value, that you engage with your stakeholders in that identification process. Then this is something that has come out of my work over the past 2.5 decades. I'm a firm believer in systems and in processes, and I would strongly suggest that you create a so-called calendar of disclosure requirements. We're going to see that ESG is by nature interdisciplinary. You might have people in different departments working on different issues, operations, you might have a sustainability department, strategy department, corporate department, and they'll be working on different things, but it would be great to have a calendar where you know when information should be collected, when that information should be shared, when you start putting together the parts of the report, and then finally deciding which reporting standard you'll use. So step one, analyze the requirements of the directive. Here I've circled those different data points, and again you'll see the EU had done its homework and its due diligence, and this is very much ESG. So you see E for environmental, S social and employee aspects, and G in anti-corruption, bribery, and diversity in the board of directors. Respect for human rights I would probably put under the S. So here you have the URL. If you haven't done so already, visit this site and conduct your due diligence, analyze the requirements of the directive. As I understand, there have already been some activities taking place in Estonia, Latvia, and Lithuania, meetings with the regulatory authorities. So also look at how the directive is being implemented in your individual market. Second step, study the various standards corporates use for ESG reporting. And here we will have a quick poll. Ava will conduct a poll. We'd like to find out if you are familiar with these standards, and then we can talk about that in the Q&A session at the end. So the most common standards are, in alphabetical order, Dow Jones Sustainability Indices. There are several free online resources, including several webinars that introduce the questionnaire that's used by Dow Jones Sustainability Indices. So that's one source of information. GRI, this is probably, along with UN Global Compact, the most widely used standard at this time. ISO 26000 is also quite widely used, but it has a little bit of a different focus. I would say it's not as geared towards institutional investors as much as it's geared towards standards and companies that might also be complying with other ISO technical standards. Then you have the OECD guidelines for multinational enterprises. These complement the OECD corporate governance guidelines. As I understand from quite a bit of literature, many investors like the Sustainability Accounting Standards Board standards. These are separate standards for different data points. So if you haven't seen this acronym before or heard about these standards, I would suggest at least to take a quick look, invest maybe a half an hour or an hour into the SASB website, take a look at the standards and learn a little bit more about them. And I'm going to share some information with you later about a report that talked about which types of standards investors find most useful. And then finally, UN Global Compact. So these are the most common. Again, Dow Jones, DGSI, Global Reporting Initiative, ISO 26000, OECD guidelines, SASB, Sustainability Accounting Standards Board, and UN Global Compact. There are also specific standards in specific areas, such as what used to be called the Carbon Disclosure Project. Now they refer to themselves only as CDP, but here they're looking at carbon emissions. Then there's the Climate Disclosure Standards Board that's looking at climate change a little bit more broadly. And then also, for example, there's a Plastic Disclosure Project that looks at plastic production of production facilities that create plastic, and then the issue of recycling or plastic created that's not recycling and is waste. Third step, conduct due diligence by utilizing the many free online resources that I've said. Now, there's too much. There's actually an embarrassment of riches. There's a wealth of information out there. In designing this webinar, I went through all of my resources and I tried to come up with a mix of things that would complement each other, that would be manageable, and that would sort of provide the whole gamut. So first of all, the Carbon Disclosure Board and CDP have put together an EU environmental reporting handbook, but here the focus is very much on those two issues, so on carbon and on emissions. Ceres is a US-based institution, so it's a little bit further afield, but they talk about a roadmap for sustainability, which could be very useful from a practical point of view of how to get started and move through the reporting process. The London Stock Exchange very recently put out its ESG reporting guide, and we're going to hear at the end of the presentation about Nasdaq's upcoming launch of its ESG reporting guide. Then you'll see I have a few slides in the presentation from MSCI that's really a leader in terms of ESG ratings and ESG indices. Here, an hour or two invested could really reap a lot of rewards because you'll be able to identify the data points, you'll get examples of best practice, you'll see who scores highly, and this can also help you design your reporting system. The Network for Business Sustainability is a Canadian organization. They have a wealth of online resources, so from Canada, the US, but also globally. Some really short articles, references, or abstracts from research done, and here too very much the focus is on the business case for ESG, the business case for ESG reporting. Schneider Electric, which is a company, but they have a really interesting site called Resource Advisor, and they've got a short manual called Sustainability Reporting 101 that takes you various steps. Again, could be useful. Source Intelligence looks at supply chain issues broadly. They cover a lot of the supply chain legislation and reporting legislation in the European Union. They have a free, I believe it's a monthly newsletter that you can subscribe to, then you'd get updates, which could be useful. And then finally, if you're really moving forward and you have the additional time, I would suggest that you look at the Model Guidance on Reporting ESG Information to Investors. This is from the Sustainable Stock Exchanges Initiative, SSE Initiative, of which Nasdaq is a member. So this guidance is actually guidance for Nasdaq on issuing its guidance to you. But it's very well written, it's not that long, and it might provide some useful insights for you as you launch the reporting process. So this is step 3, due diligence. Excuse me. Fourth, if you're a complete beginner, then we need to address the issue, as I said in my brief introduction, we need to address the issue of a baseline. You need to establish a baseline for these disclosures because you haven't been reporting previously. And here you have to have systems. You have to have the right systems in place to collect, analyze, store, report, and manage data. And that data should have the following qualities: comparability, consistency, precision, reliability, timeliness, and validity. Comparability is important for benchmarking. Consistency is that if you're collecting data in a certain way, that you use that same consistent procedure so that in year 2, when you compare the comparability is there. So consistency, for example, of the collection process. The data should be precise. It should be specific. You should know which quantities are being reported. The data should be reliable. You should be able to have systems in place that show, yes, this person collecting or entering this data into the system is authorized to do so. We don't have any data breaches. You should be collecting the information at the right time so that the situation hasn't changed. If you say that the record date is, for example, March 16th, then you should be collecting the data as soon as possible and then using that same procedure in the future, tying in with comparability and consistency. And then also the data should be valid. We do not have an audit process per se for ESG reports. This is called an assurance process by an external organization. There are a number of them. So validity is important. You collect the information and then it should be checked, double checked, and it should also be assessed by an external organization. A few best practice examples. I mentioned earlier that Denmark has had legislation in place since 2009 for reports starting in 2010. AP Møller-Mærsk, for the 4th time in 5 years, won an award for the best CSR report from the Danish auditors, Danish Chamber of Commerce and Industry, for their sustainability report. What I want to take from it and share with you from their report is a great checklist. So on the left, we see a list of issues. Then we see the guidance framework for that particular issue. And then we see which department is responsible. So the headline reads, Governance of Issues in 2016, an overview. Then there are issues that are governed by the company's framework for its commitment to sustainability called the Commit Framework. There are issues that are governed by the Sustainability Council of the company, and then there are issues that are governed by the Human Resources Board of the company. And we'll see under the Commit Framework, we've got safety, that there's a rule on HSE, Health and Safety Management Systems, and this is the Health and Safety Committee. Responsible payment of taxes, there's a rule on tax compliance and tax principles, which is currently under revision. This is the tax department. Anti-corruption, company has a rule, it's the legal department. Responsible procurement, there's a rule, the procurement department. Labor standards, rule on global labor relations, human resources. Then sustainability issues, I would say those above are generally, they're G or S. So safety would be S, responsible tax would be governance and S, anti-corruption would be governance, procurement would be governance, possibly social, labor standards would be social. Now we get into some E issues, air emissions, so the company has a position. And the technology department, also the same would be for water. Then ship recycling, there's a responsible standard. Sustainability department, climate change, emissions, the company has a position, it's a sustainability. Enabling trade, this would be social, I could put it under possibly fair trade. Sustainability, human rights, there's an action plan and sustainability, and then diversity and inclusion in the board. Company has a strategy and it's under the Human Resources Department. So once you choose your data points, you can start to map. And again, this is something different from what I was talking about, my personal recommendation from my experience and expertise, which is to also put it in the calendar format so you know not only who is doing it, but when the trigger deadlines are. 5th step. Engage with your stakeholders, including investors and shareholders and bondholders, in a dialogue about your reporting to ensure that the data you collect, analyze, report, and manage is material to them. Also, engage with them to ensure that your reporting is driven by the business case. The reporting should help identify risks, reduce operational costs, reduce negative impacts, improve operational performance, and improve financial performance. This is to the benefit of the corporation and all its stakeholders, including shareholders. Now, I realize that's a long sentence and that's a lot of different steps, but if this whole process is driven not only by compliance, but by governance of these issues, it has to be a win-win situation, because you will start to think about water use, you'll start to think about energy efficiency, you'll start to think about your employee pool, you'll start to think about your board of directors, and there'll be a focus more on improvement of the processes that will bring rewards. Yes, there's a cost to this, but conduct a cost-benefit analysis too, and then find the best ways that this whole process can bring rewards. So here we've got another Danish company. We've got Carlsberg. The CEO says, "We believe that business has a leading role to play in developing concepts such as the circular economy or closed-loop practice to drive positive change." Carlsberg takes an integrated approach to sustainability, which means that they put their sustainability report into their financial report, and they report on a range of ESG risks and impacts and their financial performance. And Carlsberg has identified 4 priority areas. Let's read below. In 2016, a materiality assessment with Business for Social Responsibility, BSR, identified the 4 most important sustainability topics, risks, and impacts for our business. These are energy and carbon, water, responsible drinking, and health and safety. So here we see in practice that this materiality assessment is very important. Here they engaged with an external service provider, and then they conducted that materiality assessment, probably internally and externally, with shareholders, owners, and stakeholders, and came up with this identification of 4 priority areas. Now we've got an example, Akzo Nobel, core principles for the company: safety, integrity, and sustainability. And they are also a prize winner in the Netherlands, so from the Ministry of Economic Affairs. Let's just read quickly. While the differences among the top 3 contenders were only minor, both the content and format of Akzo Nobel's report stood out. The report clearly shows that sustainability is fully integrated into the company's corporate strategy, tying into this point of materiality. Value creation and results are presented at the business unit level. This gives the reader an instant overview of both the positive and negative effects of business operations. They're also distinguished because they talk specifically about causes of some problems, both internally and externally, and responsibility for the supply chain. So here's another example. Akzo Nobel provides insight into environment, human, social, and financial impact indicators. In its report, it explains the lessons it's learned from conducting a pilot study and how the company plans to implement this methodology. So here too, this is part of the engagement on the issue of materiality. 6th, create a calendar of disclosure requirements that establishes a timetable. As I said, you've got E, S, and G, you've got the different departments. The calendar should identify each data point to be disclosed, the deadline for the disclosure, and then, as we saw in A.P. Møller-Mærsk, the department responsible for this disclosure. You might add a column to classify the disclosures by ESG too, because then you could break up the calendars among the individual departments. The calendar should include annual, semi-annual, quarterly, monthly, and ad hoc period disclosures. Any of those that include some E, S, or G information, however you want to structure it, or whatever the individual legislation in your country might require, and then how you would pull this all together into your report. 7th, then you'll decide which standard you'll use. For example, the International Integrated Reporting Council has a, quote, integrated model which demonstrates how 6 capitals, financial, manufactured, human, social and relationship, intellectual and natural, represent all the resources and relationships organizations utilize to create value. An integrated report looks at how the activities and capabilities of an organization transform these 6 capitals into outcomes. And here we have a diagram. You see on the left, you see all of the inputs into the business model. Then the circle represents this process we've been discussing. Roles and responsibilities, the governance, strategy and resource allocation, outlook, and performance. That circle keeps running. The business activities take place. Then there are outputs, and then there are outcomes. And if you can somehow map that also into your ESG calendar, then I think you're really getting to this step of materiality and the business case, which is our next point to cover. I think this is one of the best diagrammatic presentations of what we're trying to do here. If we look in the beginning of the process, we'll see that there's much focus on compliance. Oh, we have a corporate governance code and I don't like it and it's a pain and it's not useful. Or we have this law on ESG reporting and it costs money and you leave us alone to just do our business. If we look at the process from that point of view, we won't necessarily gain anything. But if you look at it from a strategic rethinking of what governance means, then number one, we can think about optimization. An example, energy use, water use. I mentioned to you we launched surveys of reporting on CSR in the year 2003 in Central and Eastern Europe, and people told me I was a loco. People told me I was crazy to ask questions about energy and water use. What does this have to do with financial performance? Well, we look at volatility in water prices and scarcity of water, and we'll see that this does require a system redesign. Above, governance and engaging with stakeholders binds them. You gain information, you strengthen the relationship, and together you can generate value because they start to understand the company better, they understand its challenges, and you can work together both from an optimization and from a relationship management point of view, and then you arrive at some innovation. Oh, this is how we can better engage stakeholders into our diversity program. This is how we can better engage employees into recycling and energy efficiency and reducing water use. And this leads then to strategic transformation. So here we're going to run another poll, and we'd like to learn and discuss with you, both during this webinar and also moving forward, which of these steps are familiar to you, which of these steps have you launched in this reporting process. So engaging with stakeholders, identifying material ESG disclosures, creating a process, collecting data, analyzing data, reporting data, obtaining external assurance, benchmarking against your peers, improving all of those processes, and then continuing the process. Here's a short article about sustainability and business value. I won't go into the details, but just look at the headline. Benefits from sustainability reached several $1 billion in 2015, according to Pure Strategy's global market reach. And they reached that in those different categories that we had talked about: manufacturing cost reduction, as I said, integration, supply chain issues, regulatory issues, product performance. So this is another great resource. You can just quickly open the survey, look at that list, and think, how could you build those issues into your process, both from the engagement side and also internally in integrating and engaging your employees into the reporting process. As I mentioned, we've got a number of institutions, MSCI, also FTSE Russell. FTSE was the first socially responsible investment index in the world. Enhanced ESG ratings and our new model are live. The era of ESG aware investing, where ESG are a part of investment and risk management decisions, it's evolved from niche to now normal. Here, if you look at their site too, you can see the data points for ESG governance. We've got tax transparency, risk management, corporate governance, anti-corruption, social, supply chain, labor, human rights, health and safety, customer responsibility. E, supply chain, biodiversity, climate change, pollution, resources, and water use. I mentioned previously the network of business sustainability. Take a quick look around their site. Look at, maybe you can find something that's particular to your industry. Look at some of the research that's been done about the business case for ESG. Help embed this as you start your process. This is a report I was mentioning earlier from PwC, relatively recent. For the past decade, investors have expressed interest in ESG issues, including their importance in investment decision-making. Corporates have paid attention and many are responding to investor demands. But there still isn't alignment between these two groups on why, what, where, and how often to report on ESG issues. Keep this in mind in your engagement process with your shareholders and your stakeholders. Learn what's material to them. Here's some research that was done about asset management professionals. A great number, 89%, are familiar with sustainable investment. 65% practice it, 64% believe it will keep growing. 62% they say that proof of performance would increase their interest in it. Just over half say the field lacks credible data, and just under half say they can explain to clients what sustainable investing means. Here I just want to give you a quick list, and I realize we're at time. I'll go just 2 or 3 minutes over. There are different strategies for socially responsible investment. One, sustainability themed. These could be funds or bonds that focus on gender, microfinance, organic, recycling, solar, wind, energy efficiency. Norms-based would be, again, the Convention on Cluster Munitions, as we saw in Belgium and other countries. International Labor Organization Declaration of Principles Concerning Multinational Enterprises and Social Policy, the Kyoto Accord, OECD Guidelines, UN Declaration of Human Rights, and the UN Sustainable Development Goals. This week, the World Bank issued bonds that are linked to the UN Sustainable Development Goals. Best in class would be you'd work and invest in all industries, but you would choose the best company in each industry. Integration would be that you would consider environmental, social governance, and other issues as part of your investment process. Exclusion would be you would not invest in certain vice industries. These could include alcohol, gambling, landmines, pornography. And finally, engagement and voting, that owners would say, for example, here, because I'm skipping ahead, that companies would contact the investors, would contact companies where they own shares and say, we want you to disclose information on, for example, climate change. So to wrap up, I've got in the presentation that you come back, you can come back and look at what is socially responsible investment. And here's the best definition I found over 2 years of interviewing experts on this. Responsible investing is factoring ESG concerns into investment decision making. For long-term investors, this approach is about lowering long-term risk that can arise from these factors over time, and the possibility that taking these factors into consideration in addition to financial factors may lead to outperformance of investment alpha over time. So Professor Tessaheb in Canada says, number 1, ESG can help reduce beta, and number 2, ESG can help achieve alpha. And then when asked what distinguishes SRI from mainstream investment, she says, mainstream investment continues to adhere more or less to modern portfolio theory, meaning that mainstream investors believe that the market is relatively efficient and that known and relevant information is embedded into market price. If new information is critical for the firm over time, arbitrageurs will use this information to either drive the price up or down accordingly. This view discounts most information that's not financial. But the financial crises have spawned a critique of this narrow view, and SRI, in contrast, suggests that the market is not efficient and that there's important information for long-term returns rooted in extra financial data. SRI investors seek raised ESG standards to both prevent future losses, beta, and position themselves for future positive growth, alpha. That's why ESG reporting is important. And here we have an approach from a firm that has since been bought out, but it's from the region. It's called Limestone, and it shows how they integrated ESG analysis into their process. They had across Central and Eastern Europe, which was their broad portfolio, possibly 1,000 listed companies. This was their investable universe. They conducted liquidity screening. Then they did qualitative screening, sector-based classification, compliance check. This reduced it to about 400 companies. Then they negatively screened out alcohol, tobacco, military, and gambling. This reduced it to about 300 companies. Then they did financial modeling, company visits, target value assignation, again qualitative and quantitative. This reduced it to about 30 companies, one-on-one analyst and fund manager discussions, individual decision-making, engagement with those companies on issues, and then on an ongoing basis, market intelligence, execution strategy, working with partners, settlement, compliance, and so on. So they embedded into the investment process both screening techniques as well as best-in-class techniques, and also I would say a sustainability theme, looking at companies working on issues such as water or energy efficiency, believing that they could bring them investment alpha. There's relatively new research from last year from Deutsche Asset Management and the University of Hamburg. It looks at more than 2,000 studies. The results show that the business case for ESG investing is very well founded. 90% of the studies find a non-negative relation between ESG and corporate financial performance. The large majority report positive findings. Also, this impact appears to be stable over time. And results are obtained in both portfolio and non-portfolio, in different regions and in different asset classes such as SRI emerging markets, for example, in indices, corporate bonds that are focused on ESG, and green real estate. Here's a list again of those standards that I think would be useful, and some of the reports. I'm sorry I went over about 7 minutes, but now it's time for our Q&A session. But first, I think I'll turn the floor over to Eva, and maybe we can talk a little bit about the results of the polls.
Yes, thank you, Geoffrey, about the presentation. And let's take a quick recap on the results of the poll questions. So we have the most familiar ESG standard is Global Reporting Initiative, followed by UN Global Compact, and then equally known is OECD guidelines and SASB standards. Would you like to comment this, Geoffrey? Okay, let's move on then with the second poll question and its results. And here we can see that the main activities done are engagement with stakeholders, collection of data, and identification of material ESG disclosures. Geoffrey? Okay, let's turn to our Q&A session. If this is a reminder to those who haven't yet submitted their questions, you can do it in the questions section on the settings panel zone. Geoffrey, are you still there?
Sorry, yes, I'm here.
Okay, I thought I lost you for a moment. Okay, Let's continue with the questions. So the first question is, ESG is the language to classify the risks, environmental, social, and governance, and provide data to the investors, fund managers in order to be considered when taking the investment decision. In general, all companies should be taking into account these risks as they affect companies' profitability. But what are the main reasons for disclosing such information, as information gathering and report drafting takes time and resources? Is the reason to be noticed by investors who are looking for more socially responsible companies to invest? Geoffrey?
Thank you. Yes, so I did spend some time talking about the presence of these so-called socially responsible investors who now make up about 20 to 25% of the assets under management in Europe. So yes, one simple answer would be, well, if you want to completely exclude that set of assets, which is, if you're looking globally, it's the largest in Europe and it's growing the most in Europe. So if you're in Europe and you want to exclude that potential source of capital, that would seem to me to be a mistake. But additionally, I would say that even investors who are not necessarily calling themselves SRI investors, they are starting to see the impacts, for example, of corporate scandals. Look at what happened to Volkswagen. You don't necessarily need to be an SRI investor to realize that paying these huge fines is not a good thing, and this is a governance issue. So even not strictly SRI investors are beginning to pay more attention, certainly to governance issues. I would say they're also paying more attention to environmental issues simply because of costs of energy and water and volatility of those inputs. And again, then I would say a third point would also be from the point of view of compliance driving innovation, that addressing supply chain issues can help you achieve some efficiencies over the medium to long term, bearing in mind, yes, that there are costs. You need to conduct a cost-benefit analysis, and just as you collect and report financial data or collect and report corporate governance data required by the Corporate Governance Code, you need to begin to start to do this now more broadly for ESG.
Thank you. The next question. Do you believe that the diversity of the board can be applied in the same scope to all companies from all industries?
So obviously, there are differences in the industry. You have to look at the qualifications that are required. So number one, qualifications are important. And also, I would say then it depends a little bit on the company. But as a goal, we recently celebrated International Women's Day. There's been a lot of research reported there about board diversity, the link between board diversity and then employee diversity, also financial performance. So I would say as a goal, it's something to look to. Then you need to look at the specific conditions within the company and its industry and find what type of qualified board members are out there, and then over time working towards that goal.
Thank you. The next question, calendar of disclosures. Does it mean that there are public information provided during all the year and the final report is published at the end of the year?
Thank you for that question. Great, great question, as were all the other ones. So what I'm saying here is, in your internal processes that exist before the EU directive, were you collecting information, for example, on water use, for example, or on energy use? And are you getting those, are you paying that your water bill, for example, or your energy bill monthly? And so then you would start to put that information, not just wait till the end of the year, but look at it monthly, because that could help you address the information. So one is about the inputs for the information, and then yes, the report is going to be annually. But part of the reason why we're having this webinar now is to say, don't wait until November, because November is too late. You need to be thinking now about the baseline and thinking about where you're getting all these individual inputs of data. And So, but yes, it means that there are public information that you're getting during the year. You're collecting that information, checking it, because, for example, if you're going to choose water as a report, then you're looking monthly, and then you start a process. Is there any way we can reduce water use or energy use, or is there any way we can increase recycling? By checking it monthly, you're working on the process as you collect the inputs, and then you would report annually. I hope I answered that question and also the previous ones. If there's any follow-up, then I'm happy to answer them.
Thank you. The next question: how can companies improve their reporting so that investors would be more pleased? There seems to be a gap between reporting and investor expectations.
Yes, great question. And that is the background. I hope, can you still see my slides, Eva?
Yes, I can see.
Yeah, so you see that I'm scrolling up.
So everything works, so our participants should see them as well.
Good. Okay. So this is relatively recent, and it addresses this specific question. Investors expect companies to disclose ESG information they can trust and understand, but there is work to be done to bridge the gap between what investors want and what companies are providing. So to answer your question, 2 steps. Number 1, please read this report. It's not that long. It's relatively recent. It's from PwC. This will give you a sort of a theoretical approach to the issues. Then what I was stressing throughout the presentation was that this is why you need to have this engagement process both with stakeholders and with investors, and you need them to engage with you to identify what are the material disclosures that they want to see. Then you map those material disclosures against the requirements of the EU directive. I'm scrolling back up here too to show you the example from Carlsberg. So the first part of my question was do a little bit of due diligence, do some research. Please read that PwC report. It's very useful. The second part of my response is look at the Carlsberg group. There's a little bit more background information on this materiality assessment that they did. And they engaged with an external expert organization, and then they helped identify what the 4 priority areas will be. So number 1, do your own due diligence, and then number 2, as you start to build your process, engage with investors so that they can help identify the material points, the points and data points and excuse me, information that's most material to them.
Thank you. The next question: how significant is marketing and communications part in ESG toolkit?
Very good. I think it's important at the end that you should be sharing this information, but as we saw, for example, here in the Muller-Maersk, the actual owners are broader. So we have health and safety, tax, legal, procurement, HR, technology, and then sustainability. I know in some companies it varies where the sustainability department might be, if it exists, and it also varies where the strategy department might be. But yes, this message should definitely be shared. There's no point in conducting engagement, materiality analysis, developing the processes, collecting the data if you're not going to report it out. And part of the driver so that's one response. Yes, definitely share it because you're doing this for a reason. And a second part of my response is, what were the drivers for this ESG legislation in the European Union? Well, they came because of pressure from, as I said, academics, pressure from activist NGOs, pressure from the media, from international organizations. So you want to feed back this information to them and show them that you do take these issues seriously, and you have conducted an analysis, and you are collecting this data, and you want to help that drive then consumer appreciation, stakeholder appreciation, and also investor appreciation for your efforts.
Thank you, Geoffrey. Currently, that was the last question. Therefore, perhaps let's give the floor to Maya and let's turn to our last slide.
Yeah, I will do that and I will mute myself. Just 1 second.
Hello, everybody. My name is Maya Orbidani. I'm the Issuer Relations Specialist at Nasdaq Riga, and I will be closing this presentation. First of all, thank you, Geoffrey, for such an informative webinar with a lot of tips for companies that can be used when preparing the ESG report. From our side, from Nasdaq Baltic side, I would like to inform the listeners, attendees of the webinar, that also we here in Baltic and also Nordic are looking forward to the launch of our own ESG reporting guide. And it is like another tool that can help companies in this journey while preparing the ESG reports. We will be having a dedicated website where the guidelines, the guide on ESG reporting will be published. All of you will be informed by your account managers from the Nasdaq Nordic and Baltic side. And this guide is, as I was saying, as an additional tool that can help smaller companies who haven't yet decided on any particular reporting standards to be used while preparing data on ESG. And this guide can be as a first step to get to know these different aspects on which data can be provided. So this guide will be available in English, but additionally we from the exchange side will be there to answer your questions. So after March 23rd, please feel free to approach us if you will have any questions about this ESG reporting guide published by Nasdaq Nordic and Baltic exchanges. So that's all that I wanted to add to this webinar, to this information. If anybody else has some questions, we will be here for a couple of minutes more. So please type in your questions in the chat box. But while you are typing and we are still waiting for some last questions to come, I would like to say a huge thank you to Geoffrey for giving this webinar. I believe that we have all learned some new things and get useful internet addresses where we can look for information and improve our knowledge about the ESG scope and be much more ready for the reports to be published next year. So thank you.
Maya, a question to you. Is this guide mandatory?
Of course not. The guide is totally voluntary, and companies, issuers are totally free in choosing the reporting format, reporting standards, on choosing the guide to which to follow. So we are just adding another tool or another guide which can be used. But of course, it's companies' issuers' decision whether to look on this guide or not. Any of the guides out there can be used. So it's totally voluntary. It's not mandatory in any sense, and it's also not like binding document. It's not rules. It's not law. So companies can choose on their own whether to use it or not. So it's just to be there as a help. And it can be used, but again, the company's issuers can decide on their own whether to follow this.
Yes, thank you. Currently, all questions have been answered, and I wanted to remind you that recording of the webinar will be available in the Nasdaq Baltic YouTube channel, and it will be also sent to your email addresses together with the presentation. And participants, thank you for joining. Geoffrey, thanks for spending the last hour with us, and Maya, thank you as well.
Thanks to both of you. Thanks for everyone for joining. I've really enjoyed it, and look forward to see how the reporting process unfolds in Estonia, Latvia, and Lithuania. So thank you very much, and wish everyone a lovely evening.
Thank you.